Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Jeff Rosenkranz, the portfolio manager with Shelton Capital Management. We're going to take a look at the credit markets. Jeff, it's great to see you. Welcome to Trade Talks.
Great to be here. Thanks for having me.
You got it. Let's talk about the credit markets here. We saw rates trickle down a bit in January, rise quite dramatically in February, and by the way, time credit spreads have tightened. What does this all mean for fixed income?
Yeah, there's a confluence of a lot of events right now, but what it means is all-in rates have been moving up. The Fed is having to push really hard to raise interest rates to cool the economy and cool inflation. But what that's telling us is that investors are demanding more yield to hold bonds, and they're perceiving them as riskier.
And let's talk about what's happening in jobs. Of course, a big week for it. Of course, second week in March. What happened with the JOLTS report, and what are you going to be looking for in terms of the jobs number on Friday? How's that going to impact the Fed's decisions?
Sure. So the JOLTS report, it showed a little bit of improvement from revised December numbers, but not enough for the Fed to feel comfortable that they're making enough progress cooling inflation. So we're certainly going to look at the jobs report tomorrow to see signs as to where we are, but it's going to take, and the Fed has told us that they're going to need to see several months in a row of trend to convince themselves that they're really on a path. So we look for them to raise rates. The market's pricing in 50 basis points more likely than 25 now for the March meeting, and we would tend to agree with that. We'll see what the jobs report is tomorrow. Fed Chairman Powell said, nothing's locked in yet for the March meeting, and it's going to continue to depend on the incoming data. So we're all kind of watching the data, parsing it to see where we are. But if we take a step back, not enough progress has been made. We know monetary policy operates with a lag, and so we've been patient, waiting for those lag impacts to take hold. But the Fed really miscalculated in the fall when they allowed financial conditions to ease. And so what you're seeing now the last couple of months is the economy is maybe showing signs of reaccelerating a little bit, and it's complicating the Fed's issues here, and it's just making it even tougher. So I think that's why they're needing to, get a little tougher and push a little harder now here over the next few months.
So, Jeff, the market clearly is in a tug of war with the Fed. Everything's predicated on what's happening with the macro. We're trying to debate, right? Is it going to be a soft landing? Is it going to be a hard landing? What are your thoughts?
Yeah, and even, the last couple of months, you've heard some market participants even throw around the term no landing, as crazy as that may seem. We think it has to be of the harder variety. What they're doing so far is not working. And so in order to push unemployment higher and cool some of the pressures in the economy, by necessity, that's going to dictate a recession. And so, again, we look for it to be harder rather than softer, and certainly think the notion of no landing at all, we just don't see how the Fed could allow that to happen and magically have inflation go away. It just seems really unrealistic to us.
So let's put all this together, right? We have the macro factors. We have a rising interest rate environment for perhaps longer. We have, what's happening with spreads and so forth. Could this potentially be the golden age of fixed income investing?
We think it could be, yeah. I mean, rates are all-in yields, and rates are higher than they've been in a long time. When you can get 5 3/4 on triple Bs, 7 1/4, 7.5, 7 3/4% on solid double Bs, almost 9% on high yield overall, and 9% on single Bs. We think these yields are really attractive. Doesn't mean that you just indiscriminately buy all bonds. I think you really need to discern and buy bonds of borrowers that are going to be resilient in this harder landing that we see coming, because you want to make sure you're going to get repaid, right? So There is a lot of yield to be had. Do your homework, do your credit work. Active management makes a lot of sense right now because I think just buying the bond market is a little too simplistic, but these all-in yields are really compelling, especially compared to a lot of other risk assets and how they would behave in a slowdown or a recession.
So, Jeff, to wrap up here, if you were to look in an area within the fixed income markets, is there one that's more attractive or safer than the other that you're putting money into?
I think the sweet spot in our view is triple B, double B, and select single Bs. That sort of band of credit quality where you're getting great yield, but you're not taking undue or unnecessary risk going even further down the credit spectrum into a recession. So we are focusing primarily in that band with a few small exceptions, but that triple B, double B, and select single Bs feels like a sweet spot to us.
All right, Jeff, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.